Hey guys, welcome back on the channel. So this week is actually the worst week since I started doing this journey on PancakeSwap. It has also to do with the fact that the cake incentives are not as high as before, but so far I had days in the red before since I started this, but not a whole week. Although in the past weekend the performance was quite good, I had topped up the pools, having overall a portfolio value at around $400, and they were still yielding, even during the weekend, 5% a day. So it was really good. This week, let me share with you some of the things that impacted the yield. So mainly also, it was the fact that on Monday and Tuesday, there were a lot of red. So this is my short list. So right now you can see there's still some here with minus 10%, minus 6 too, but past Monday and Tuesday, it was a rougher day. The whole market dropped at on average 10%. And this is actually something that I have been noticing for the past couple weeks at least. On Mondays, the market goes down. So I did mess up in that regard because I was topping up pools and opening new ones during the weekend. And I should have noted that and started only doing that in between Monday and Tuesday. It's like I said in one of my, actually the video before this one, you want to bite the dip. The entry point in these high APRs, narrow ranges strategies, it's very important. So you don't want to get in when it's green. This is generally speaking, of course, but you want to buy when it's red, especially if you're looking at stuff like Solana, blue chips, right? Buy the dip, they will bounce back up eventually. And when they do bounce back up, of course, they bring the whole market alongside with them. A rising tide raises all boats, as the saying goes. So that is something I will from here on start taking into consideration. If you go here into my shortlist of pools to farm with these type of strategies, you see that mostly everything is down 10%, 15, 17%. So I will take this information and apply it in the following weeks. I will stop buying into new pools on Sundays, and then Monday, Tuesday, that will be the better point in time in order to get in and open new positions. And also, let me share with you something that you shouldn't do. I did this myself, fully knowing the risks, but in case you're new to this, you shouldn't want to have too much exposure to a given liquidity pool, especially if it's something new. And the example here is perfect with cards. I was yield farming this with $100, then I deposited 50 more. Essentially, it wasn't outside money, it was just money from some other pools, and they were not yielding as much. If you look at these APRs, they're always above 999% because I try to keep it like that. But also you do not want to have too much exposure on your portfolio to a given liquidity pool, unless it's a blue chip, something that you can rely on. And in my case, I did a bet on this one. It was paying out really good incentives, but suddenly the price started going down. And if I go back here to the X screener, let me show you. So actually it's up 11% for the past 24 hours, but for a couple days it was down 10, 20, at some point even 30% down on the price. Price right now it's at 18 cents. At some point it was above 30, so I can even show you the chart here. So it was quite a substantial drop. From these blue lines, this was the previous range I was farming on. But then again, it was a personal bet. I knew the risks, so I'm sharing this with you so that you understand the importance of diversifying. And if you want to diversify, that's going to be also something that will take more of your time. So you will have to be exposed to different pools, right? So it takes a little bit more time when it comes to managing the position. So instead you could think, okay, so let me keep with one position and keep on deploying liquidity there. So that's something you can definitely do, keep compounding. But as you will notice, the APR at some point, as you keep depositing, it will start going down. And I've experienced that with multiple pools. I believe that's because PancakeSwap wants ultimately for the users to spread their assets through different liquidity pools. As you can see, there are multiple ones being heavily incentivized. So this is, I believe, to avoid that people come in and deploy, for example, $1,000 into a single liquidity pool. So instead, I think they are doing this to promote users to, instead of deploying, let's say, $1,000 here, they will then deposit 100 and then find some other pools to deposit the rest and allocate deposits evenly through multiple pools, overall to incentivize the Solana ecosystem, the Solana liquidity pools available on PancakeSwap overall, because that's the point of all of these incentives. convince users to use PancakeSwap to provide liquidity to deposit their capital. They're trying to get some market share out of Solana, which is one of the biggest blockchains, also when it comes to volume, to fees, to all of that. So it's very profitable. That's why PancakeSwap did expand also to that ecosystem. So these are a couple of things for you to consider. But of course, you could still, regardless, deploy most of your assets into one or a couple of liquidity pools. That is what I had been doing for the initial 2 months. But if you want to make the most out of the APR, you will notice just that. Just try it out for yourself, deposit 50, then 50 more, and you will see that a liquidity pool, the APR will just substantially go down as you keep stacking more liquidity into it. So overall, let me go here on Jupiter and let me show you how much cake this week yielded. So 26 cake tokens, overall $76 worth of fees generated in this past week. If I add this number to my current LP value, it's not even going to put me on the green. That is how harsh this week has been. But again, you only lose if you go out of your position. If you wait and if it bounces back up, which I am anticipating, these couple pools will just go back into range, and then I'll have my LP value much more balanced if that happens. But overall, let's pull up the calculator. All of these LP positions summed up, they account for 318, and here I have $76 also worth of cake. So 318 plus 76. I'm slightly down, and I'm heavily reliant now on how these pools will perform in the future. If it will bounce back up or not, I believe it will. It's going to be a matter of holding, but then again, like I said before, it's already too much of risk exposure. But also looking at the overall performance of the pools this week, I did widen up the ranges a little bit more, and also the market has not been as active, and that will be something that will happen. There will be times where markets are hotter, as well as sometimes they will be cooler. This week has been much cooler. Still, this week my portfolio was able to yield 5% of its worth just in cake. If we account with the LP fees, it's probably going to double that and make it at around 10. Right now, the cake incentives are not as high as before. When I started this, if you go and watch those videos, I'll leave a link for the playlist down under, and also I will link that in the end of this video. But most of these pools were higher than 999% APR in cake incentives. That means that the decrease in incentives paid in cake is also reflecting this week in the yield. But at the same time, let me show you cake's price here on CoinGecko. So for the past week, actually cake went up 15% in price, so this was kind of good to offset the overall loss. And that leads me to another important point, which is whenever you're taking profits, you should be de-risking. And when you're getting incentives in a token which is outside of your portfolio, right? If we come here to my positions, none of this has exposure to cake. So farming cake automatically here, it's already good because I don't have to manage that and swap tokens into cake. And some of that risk, it's already off the table because of that. And you could do the same thing, but instead of using cake, just swap it, for example, for Ethereum, for Solana, for Bitcoin, a blue chip asset, or something which you are not exposed here on the list, even a stable coin that can work as well. But in this case, played out really good with cake because of the price appreciation. Like I said in many of my other videos, I think cake is a $5 token at least, so I don't even mind to hold cake at this current price, or even if it drops below $2, I think it's going to be a bargain at that price point. And let me add on, as you can see here, whenever cake goes up $3, it's going to have some correction. So if you're not bullish on cake, but you are still yield farming, do account for that. If you see the price at $3, you probably want to sell because it might not last at around that price range. Although we're not far yet, but this is also a way to show you how to de-risk and how it is important to have exposure to multiple assets. And that's actually something that worked out in my favor this week and did offset the losses, at least to some extent. So overall, although it was a really bad week, it wasn't all that bad because Cake did perform really well. So to sum it up, guys, don't have too much exposure to a given asset unless it's a blue chip and you are tremendously bullish on it. This is for all the beginners out there. Remember, I'm showing you the whole risk aspect to this because I know it's pretty tempting to see these crazy yields and try to replicate that, but it's not always going to be green. So do have that in mind, okay? Then use your profits to de-risk, and whenever you go out of range on the upside, you will see that your position will appreciate in value. It might also be a good idea to take that extra percentage that it did appreciate and de-risk. Turn it into stables, to blue chips, to whatever you want, but de-risk, because at some point the chart will go down, and if it starts to go down, you can then use those assets to buy in the dip. In theory, that will work well if you manage to buy the dip and then you see the price going back up again. That's going to be optimal, of course. So remember, it is always a good idea to keep some of the profits on the side in order to account for potential price drops where you need to top up the pools. And these are some ways that you can also grow your bag when the price goes up and have those assets ready to work if it comes to be. So if you have any questions, let me know in the comments. If you're new to the channel and enjoy this type of content, like and subscribe for more. Thank you for watching. Take care. Keep exploring crypto. I'll see you on the next one.